If you want to replace your paycheck with investment income, you have to understand the problem correctly. Most people think the problem is that they do not earn enough. That is usually not the real problem. The real problem is that their entire life depends on one source of cash flow, and that source requires them to keep showing up every day. When you have a job, the system is simple. You trade time, energy, attention, and stress for money. As long as you keep going to work, the money comes in. The moment you stop, the income stops too. That is not freedom. It is a dependency. And dependencies matter because every dependency creates risk. If you earn $80,000 a year from your job and you want to stop working without changing your life, then your investments eventually need to produce $80,000 a year in income. Not in theory, not on a spreadsheet that assumes perfect returns. Real income, spendable income. Income that can pay the mortgage, the food bill, the insurance bill, the tax bill, and the unexpected expense that always seems to arrive at the wrong time. This is where most people get confused. They hear that the S&P 500 is a good long-term investment. And that is true. I believe broad ownership of productive businesses is one of the most reliable ways to participate in the growth of the economy over long periods of time. But there is a difference between building wealth and creating income. If you are 30 years old and still working, you can focus primarily on compounding. You can keep reinvesting. You can accept volatility. You can let the system work for you over decades. But if your goal is to replace a paycheck, you need to think in another way. You need to ask a different question. What assets can turn capital into recurring cash flow? That is the central question, and I want to be very clear before I go further. This is not easy. It does not happen overnight. It requires money, it requires sacrifice, it requires patience, it requires the ability to understand trade-offs instead of chasing whatever looks exciting in the moment. Most people do not want to hear that. They want the result without the process. But that is not how money works. Money follows systems. And if you want your money to pay you, you have to build a system that does exactly that. The simplest starting point is Treasury bonds. This is where you lend money to the United States government, and in exchange, the government pays you interest. That interest can become one stream of income. Now, in a world filled with complex investments, derivatives, private funds, cryptocurrencies, structured products, and all kinds of things that people often do not understand, treasuries are relatively simple. You lend to the government owes you interest. That is the basic contract. The advantage is that treasuries are generally considered one of the lowest risk dollar-denominated assets. They are backed by the taxing power of the United States and by the Federal Reserve's ability to create dollars. If the United States government could not pay its bills, the problem would be far larger than one person's treasury position. It would be a global financial crisis. Another advantage is that the interest from treasuries is generally not subject to state taxes. That matters because income is not just about what you receive, it is about what you keep after taxes. If one investor receives interest from a high-yield savings account and another receives similar interest from treasuries, the after-tax result can be different depending on the state they live in. That is why taxes are part of the system. They are not a side detail. A third advantage is that treasury income can be structured in a way that produces regular payments. Some investors use treasury bills directly through Treasury Direct. Others use treasury bond ETFs such as SCOV, which holds short-term treasury bills that mature in 3 months or less. At the time the original example was recorded, SCOV was paying around 4.7% annually, with distributions paid monthly. That sounds simple, but simple does not mean perfect. The first limitation is that treasuries do not create much growth in principal. If you lend $100, the $100 does not become $150 because the government became more productive. You receive interest on the $100 that is different from owning a business whose profits may grow over time. The second limitation is that returns are capped by the interest rate environment. When rates are high, income looks attractive. When the Federal Reserve cuts rates, that income may fall. A treasury income strategy depends heavily on the interest rate cycle. The third limitation is psychological. People sometimes mistake low risk for no risk. Treasuries are not FDIC, insured bank deposits. They are promises of the United States government. That promise has historically been strong, but every asset is a contract, and every contract has conditions. So treasuries can be a useful foundation for income, especially for stability. But they are not a complete solution. If your entire plan is to live off treasury interest, you must understand that the income can change, and your capital will not grow very much. In a world where costs rise over time, that matters. The second income asset is dividend, paying ETFs. This is where the idea begins to move from lending money to owning productive assets. A dividend is a distribution of profit. A company earns money, pays its expenses, reinvests what it needs, and then may send a portion of the remaining profit back to shareholders. If you own shares, you own a small claim on that business. When the business pays a dividend, you receive your share. That is the logic. A company like McDonald's, for example, can earn large profits year after year if management decides that the business does not need all of those profits for reinvestment. It may return some of that money to shareholders through dividends. But owning one dividend stock creates company-specific risk. One company can make bad decisions. It can take on too much debt, it can hire the wrong leadership, it can face changing consumer behavior, it can lose its competitive edge, it can cut its dividend. In extreme cases, it can fail. When that happens, the investor may lose income and capital at the same time. That is why many people use dividend ETFs instead of buying only one company. An ETF can own a basket of dividend-paying stocks. If one company deteriorates, the fund can reduce or remove that exposure and replace it with another company based on the fund's rules. That does not eliminate risk, but it reduces the risk that one company destroys the entire income stream. There are different types of dividend ETFs. One category is dividend aristocrat exposure. An ETF like Noble gives exposure to S&P 500 companies that have not only paid dividends but have increased those dividends every year for at least 25 years. That kind of record matters because it suggests durability. It suggests that the company has been through recessions, inflation cycles, rate cycles, and competitive pressure and still found a way to return cash to shareholders. At the time of the example, Noble was paying a little over 2% annually in dividends. That is not a huge yield. But again, yield is not the only thing that matters. A low yield from durable businesses may be better than a high yield from weak businesses. Many investors make the mistake of chasing the largest dividend number, but a dividend is only valuable if it is sustainable. Another category is broader high dividend exposure, such as CHD. SHD is designed to give exposure to high dividend paying companies in the United States. In the original example, it was paying around 4% annually. That begins to look more meaningful from an income standpoint. But the same principle applies. You have to look beneath the yield. You have to ask what you actually own. Are the companies profitable? Are they growing? Do they have strong balance sheets? Are the dividends supported by cash flows? Is the fund concentrated in one sector? Is it exposed to interest rate sensitivity? Income investing fails when people look only at the payout and ignore the machine producing the payout. That is like judging a person's health by how loudly they speak. The third category is international dividend ETFs. This matters because the world is bigger than one country. Many investors, especially in the United States, naturally hold most of their money in domestic markets. That has worked very well for a long time. But when building an income system, it can make sense to consider whether other markets offer different income characteristics, different valuation levels, and different growth opportunities. International dividend ETFs such as VME or IDV can provide exposure to high dividend, paying companies outside the United States. In the original example, VME was paying around 4% annually, and IDV around 5%. But international exposure also brings different risks. Some countries have less stable political systems, some have weaker currencies, some have different accounting standards, some have slower growth, some have faster growth but more volatility. Some companies pay attractive dividends but operate in economies that are less predictable. So international dividend income can be useful, but it must be understood as part of a diversified system, not as a magic solution. The next category within dividend ETFs is real estate investment trusts or REITs. A REIT allows you to get exposure to real estate without directly buying and managing property. Some REITs own physical properties like apartments, offices, hotels, warehouses, and retail centers. Others, called mortgage REITs, invest in the loans tied to real estate rather than the real estate itself. A fund like VNQ gives exposure to real estate REITs. A fund like REM gives exposure to mortgage REITs. In the original example, VNQ was paying around 4% annually while REM was paying around 9.5%. The 9.5% number is the kind of thing that attracts people quickly. That is exactly why it has to be treated carefully. A high yield is often high for a reason. It may reflect higher risk, higher volatility, more leverage, more sensitivity to interest rates, or lower confidence in the durability of the payout. If the underlying asset falls enough, the large dividend does not protect you. you can receive income while losing more in principal. This is one of the most important principles in income investing. Do not buy yield, buy quality assets that can produce income. The difference is enormous. Bad income is not income, it is capital returning to you while the asset underneath deteriorates. Good income is the result of a productive asset generating cash flow and sharing that cash flow with you. That distinction decides whether income makes you freer or poorer. The third asset is real property. This is more advanced because real estate requires more work, more judgment, and more operational understanding. There are two broad ways to do it. You can buy rental property yourself, or you can invest in someone else's real estate deal through a syndication or crowdfunded structure. The first gives you more control and more responsibility. The second may be more passive but creates different risks, such as sponsor risk, liquidity risk, fee risk, and lack of control. Let me focus on the direct ownership model because it makes the mechanics easiest to understand. Suppose you buy a single-family house as an investment. You do not buy it to live in. You buy it so another family can live in it and pay you rent. The rent comes in every month. From that rent, you pay property taxes, insurance, maintenance, management fees, and vacancy costs. Whatever remains after those expenses is your operating profit. That is the cash flow. Real estate is powerful for several reasons. First, it can create steady income if bought correctly. Each property can become one small engine of cash flow. One property may not change your life, but multiple good properties owned over time can begin to form a serious income system. Second, real estate is a hard asset. You own land, walls, windows, roofs, plumbing, and physical space. That does not mean it cannot fall in value. It can, but it exists in the real world, and real world assets often behave differently from financial assets. Third, real estate has tax advantages. The tax code often treats real estate investors favorably because real estate is capital intensive, creates housing, and involves depreciating structures. Depreciation is one of the key concepts. If you buy a property for $200,000, part of that value may be assigned to land and part to the building. Land is not depreciated. The building is. If the building value is $170,000, the tax code may allow you to deduct a portion of that value each year as depreciation because the property is getting older on paper. This can reduce taxable income even while the property is producing cash flow. There may also be ordinary and necessary business deductions connected to operating the rental property, such as management, repairs, professional services, software, and other legitimate expenses. But real estate is not passive in the way many people imagine. Even if you hire a property manager, you still own the problem. Tenants move out, toilets break, roofs age, insurance costs rise, property taxes change, local regulations change, markets change. That is why the numbers must work from the start. Suppose you buy a property for $200,000. It rents for $2,000 a month or $24,000 a year. After paying property taxes, insurance, maintenance, management, and vacancy reserves. Suppose you are left with $10,000 a year. If you bought the property all cash for $200,000, that is a 5% return on cash. Is that good? It depends. You compare it with the alternatives, you compare it with Treasuries, you compare it with Dividend ETFs, you compare it with the amount of work and risk involved, you compare it with your own goals. In the source example, the preference was closer to a 7% cash on cash return. That would mean wanting $14,000 a year on a $200,000 cash investment. That is harder to find, but hard does not mean impossible. Markets become difficult. In hot housing markets, good deals are harder to find. But the difficulty is part of the filter. Most people stop when the obvious deals disappear. Serious investors keep looking, keep underwriting, keep comparing, keep walking away from bad numbers. That is important in investing. Saying no is a skill. Real estate can be an excellent income asset, but only when bought at the right price, financed prudently, managed professionally, and understood realistically. It can create cash flow. It can create tax advantages. It can build equity. It can provide inflation protection through rents and replacement costs. But it can also become a burden if you buy without understanding the real expenses. The mistake many people make is that they look at rent and ignore the system around rent. Rent is not profit. Rent is revenue. Profit is what remains after reality enters the room. The fourth asset is ownership in a business. This is more advanced because business ownership has the potential for very high returns, but it also has a high failure rate, high complexity, and high personal demands. There is a big difference between being an employee and being an owner. An employee earns wages or salary for work performed. The business may do well or poorly, but the employee's compensation is tied mainly to their role. An owner owns the residual profits of the business. That means after the business pays salaries, software, rent, marketing, taxes, contractors, insurance, and every other expense, whatever remains belongs to the owners. Based on their ownership structure, this is why business ownership can create wealth. But it is also why business ownership is hard. The owner gets what is left over. And sometimes what is left over is nothing. Sometimes it is negative. Sometimes the owner works the hardest and gets paid the least, at least in the early years. There are two basic paths. You can start a business or you can buy a business. Starting a business usually requires less capital but more uncertainty. You are creating something from zero. You have to find customers, create value, build systems, hire people, manage cash flow, compete, survive mistakes, and keep going long enough for the business to become real. Buying a business may give you an existing revenue stream, existing customers, existing employees, and operating history. But it usually requires more capital and better due diligence. You have to understand whether the business depends on the current owner, whether the numbers are real, whether customers will stay, whether employees will leave, whether margins can survive, and whether you are buying a machine or just buying a job. That distinction matters. Many small businesses are not passive investments. They are jobs wearing the clothing of assets. If a laundromat, car wash, restaurant, service company, or online store only works because the owner is constantly inside the business solving problems, then buying it may not replace your paycheck. It may replace your job with a different job. That may still be worth doing for the right person, but it is not passive income. To make business ownership more passive, you usually need one of two things. You need enough capital to buy a larger, more professionally managed business, or you need the ability to build systems so the company can operate without you in the center of every decision. That is hard, but that is also why the rewards can be large. A good business is a cash flow machine. It solves a problem for customers. It produces value. It earns revenue. It pays expenses. It reinvests. It distributes profits. It may grow over time. It may become more valuable because its earnings increase. But a bad business consumes capital, attention, and energy. This is why the question is not, can I buy a business? The question is, can I understand the system that makes this business work? What is the customer acquisition system? What is the margin structure? What costs are fixed and what costs are variable? What happens in a recession? How dependent is the business on one supplier, one employee, one customer, one platform, one location, or one owner? Where are the hidden liabilities? What capital expenditures are coming? What does the cash flow look like after paying a real manager to run it? If those questions sound difficult, that is because they are. But difficulty is not a reason to avoid something. It is a reason to respect it. Business ownership is one of the most powerful ways to create income. But it requires the investor to think like an operator, not just a buyer. The fifth asset is peer-to-peer lending or private credit. This means lending money to other people or businesses and receiving interest in return. Instead of lending to the United States government through Treasuries, you lend to a borrower who may need money for a project, a property, a vehicle, a business, or some other purpose. The income can be attractive. In some private credit markets, interest rates can be 5%, 10%, 15%, or even higher. But higher yield means higher risk. Always, if a borrower is willing to pay 10% or more for money, you have to ask why. Maybe they are flipping real estate and the economics justify the cost of capital. Maybe they need bridge financing. Maybe they cannot qualify for cheaper financing. Maybe the loan is riskier than it appears. The lender's job is not to be excited by the interest rate. The lender's job is to understand the downside. What happens if the borrower does not pay? Is there collateral? Is the collateral real? Is the collateral worth enough? Can you enforce your claim? How long would enforcement take? What is the legal structure? Who services the loan? What fees are involved? How diversified are you across borrowers? What happens in a downturn when multiple borrowers fail at the same time? Private credit can create income, but it can also create hidden risk because the income often appears stable until suddenly it is not. When things go well, the lender receives interest and feels intelligent. When things go badly, the lender discovers whether the underwriting was real, collateral matters, documentation matters, diversification matters, legal rights matter, experience matters. This is not a game for blind trust. The source example made a careful point here. The speaker had not personally done peer-to-peer lending and therefore did not claim expertise in how to execute it. That is the right attitude. The right investor knows the edge of his own knowledge. That is a principle. You do not have to invest in everything. In fact, one of the best ways to protect your wealth is to know which opportunities are outside your circle of competence. Now, when you step back and look at these 5 assets together, you can see the progression. Treasuries are the simplest. They are relatively stable, lower return income assets tied to government obligations. Dividend ETFs are ownership in baskets of companies that distribute profits with more growth potential but more market volatility. Real estate is a hard asset income system that can produce cash flow and tax advantages but requires serious operational understanding. Business ownership can create substantial income and wealth, but it requires the ability to understand or build an operating machine. Private credit can create high income, but the risk is in the borrower, the collateral, and the structure. Each asset has a different role. Each asset has a different risk. Each asset solves one problem while creating another. That is why the goal is not to find the one perfect asset. There is no such thing. The goal is to understand the mechanics well enough to build a resilient income system. This is how I think about income. You start by defining the target. If your paycheck is $80,000 a year, replacing it requires roughly $80,000 a year in investment income if you want to maintain the same lifestyle, but you also have to account for taxes, inflation, emergencies, and variability. So the real number may be higher, then you break the target into streams. Maybe part of the income comes from treasuries, maybe part comes from dividend ETFs, maybe part comes from real estate, maybe part comes from a business, maybe part comes from private credit. If you understand it well enough, the power is not in any single stream. The power is in the system. A single income stream can fail. A system can adapt. This is the difference between dependence and resilience. Most people are fragile because their income depends on one employer, one industry, one boss, one paycheck, one schedule, and one economic environment. The purpose of investing for income is to gradually reduce that fragility. You are not trying to become rich overnight. You are trying to move from dependence to optionality. Optionality means you can keep working because you choose to, not because the bills force you to. Optionality means that if you lose a job, you are not immediately in crisis. Optionality means that your money is no longer idle. It is working in different ways across different systems. But optionality must be earned. It is earned by spending less than you make. It is earned by saving capital. It is earned by studying how assets actually work. It is earned by avoiding bad debt. It is earned by refusing to chase yield without understanding risk. It is earned by recognizing that every investment is a machine, and every machine has inputs, outputs, incentives, and failure points. If you want treasury income, understand rates. If you want dividend income, understand business quality and payout sustainability. If you want real estate income, understand net operating income, vacancies, maintenance, management, financing, taxes, and cash, on-cash return. If you want business income, understand customers, margins, systems, people, and owner dependence. If you want private credit income, understand underwriting, collateral, legal rights, and default risk. Do not let anyone sell you the fantasy that income is automatic. It is not automatic. It is engineered. And like every engineered system, the weaknesses matter as much as the strengths. The reason many people never replace their paycheck is not that the assets are unavailable. The assets exist, the mechanisms are known, the examples are everywhere. The reason is that they do not build the capital base, or they do not understand the trade-offs, or they chase income too aggressively, or they underestimate how much work it takes. They want passive income before they have active discipline. That does not work. Before money can work for you, you usually have to work on yourself. You have to change how you spend. You have to change how you save. You have to change how you think about risk. You have to change how you respond to volatility. You have to stop confusing excitement with opportunity. The most dangerous income investments are usually the ones that look easiest. A 12% yield with no work, a rental property with no maintenance, a business that runs itself alone with no default risk. These things sound attractive because they remove the pain from the story, but pain is information. When someone removes the trade-offs from an investment, they are usually removing the truth. That is why I would rather start with a simple framework. First, know how much income you need. Second, know how much capital each asset class requires to produce that income at realistic yields. Third, know the risks that can interrupt that income. Fourth, diversify across streams instead of relying on one-fifth. Keep learning because the system changes. If treasury yields fall, your treasury income falls. If a dividend ETF's underlying companies weaken, the dividend can change. If property taxes and insurance rise, real estate cash flow can compress. If a business loses customers, profits disappear. If borrowers default, Private credit income stops. Nothing is permanent. That is why investing is not about certainty. It is about probabilities, preparation, and resilience. The great mistake is to think that a paycheck is safe and investments are risky. A paycheck is also risky. It depends on one buyer of your labor. It depends on your health. It depends on your industry. It depends on management decisions you do not control. It depends on economic cycles. It depends on whether your skills remain valuable. Investments have risks, but a well-built investment system can diversify those risks. That is the point. You are not replacing one paycheck with one asset. You are replacing one fragile source of income with a network of cash, flowing assets that takes time. In the beginning, the income may be small, a few dollars a month from a Treasury ETF, a quarterly dividend, a small distribution, a little rental cash flow, a small business profit interest from a loan. At first, it looks insignificant, but systems compound, you reinvest, you add capital, you improve your judgment, you avoid mistakes, you learn which assets fit your temperament. You learn what kind of work you are willing to do and what kind you are not willing to do. Over time, the small streams become meaningful, and then one day, you look at the system and realize something important. Your job is no longer the only thing paying you. That is the first moment of real financial power. Not because you can stop working immediately, but because the dependence has begun to break. That is how freedom is built, not through a single dramatic trade, not through a lottery ticket, not through a viral opportunity. Through the steady conversion of labor income into asset income. That is the principle: earn actively, spend carefully, invest intelligently. Build income streams, understand risk, repeat long enough for the system to matter, and do not confuse the simplicity of the idea with the difficulty of the execution. Replacing a paycheck is possible, but it is not a hack, it is not a shortcut. It is a long, disciplined transition from being paid for what you do to being paid for what you own. That transition changes everything, because when you live only from a paycheck, you are always negotiating with time. When you live from assets, time begins to work for you. That is the real goal. Not to stop being productive, not to stop contributing, not to sit around and do nothing. The goal is to own enough productive assets that your life is no longer controlled by the next paycheck. That is what most people actually mean when they say they want passive income. They want control, they want security, they want flexibility, they want the ability to choose, and the only reliable way I know to get there is to build a system of assets that can keep producing cash flow, whether you go to work that day or not. That is why these 5 categories matter. Treasuries teach stability. Dividend ETFs teach ownership of cash. Producing businesses, real estate teaches hard asset cash flow and tax structure. Business ownership teaches residual profit. Private credit teaches lending and risk pricing together. They form a map, not a guarantee, a map. And if you follow the map with patience, discipline, and clear thinking, you can begin to replace earned income with investment income. But if you chase the highest yield, ignore the risks, underestimate the work, or believe that income without understanding is safe, you will probably learn the expensive way. The financial world does not reward people for wanting freedom. It rewards people for understanding systems. So build the system, build it slowly, build it carefully, build it with assets you actually understand. And remember that the goal is not to look rich. The goal is to become less dependent. That is how real wealth begins.